All right, today we are diving deep into one of the most brutal 24-hour periods in the entire history of crypto, the insane crash of October 2025. This thing was a perfect storm of global politics, raw panic, and a tiny hidden flaw that ended up costing billions. Let's get into it.
But first, you know the drill, we have to get this out of the way. All the information we're covering here is for educational purposes only. It is absolutely not financial, legal, or any other kind of professional advice. Everything we're talking about comes directly from the source articles we used for this investigation.
I want to start with just one number: $20 billion. That's how much value was basically vaporized from the crypto market in a single day. A financial shockwave that was felt by literally millions of people.
One analyst at the time really captured the mood perfectly. He just said, Bitcoin is covered in blood. It's intense, right? But it gives you a real sense of the chaos that was unfolding on October 10th. So, what the heck actually happened?
Okay, so let's start our investigation right at the scene of the crash, taking a look at the immediate, and I mean catastrophic, fallout. The scale of the damage was just staggering. We're talking more than $20 billion in leveraged positions getting force-sold, what's called liquidated, impacting 1.6 million individual traders. Bitcoin just cratered, plunging over 14%. Ethereum and the other big coins weren't far behind, dropping anywhere from 12 to 20%. And the smaller tokens? Oh man, some of them collapsed 50, even 90% in minutes. It was a complete and total system flush.
You know, every massive fire needs a spark. And for this meltdown, that spark came straight from the world of geopolitics, a real political bombshell.
And this timeline shows you just how fast everything went sideways. On October 9th, China makes a move on rare earth metals, which kind of puts the markets on edge. But the real explosion happens the very next day. Former President Trump announces a plan for 100%, that's 100% tariffs on all Chinese imports. The reaction was instant, it was brutal, and it spilled right over into crypto.
So here's the crucial thing to understand. This didn't start as a crypto problem. The tariff announcement kicked off what's called a classic risk-off event. Basically, investors all over the world started dumping their riskiest assets, and you better believe crypto was right at the top of that list. But here's the catch. The tariffs were just the trigger. The real damage was caused by something that was already hiding deep inside the system.
Right, so that political bombshell? It only lit a fire that was already soaked in gasoline. The market was completely primed for a disaster. And that hidden fuel, it was a huge, lopsided pile of incredibly risky bets.
So, to really get this, we need to quickly talk about leverage. Put simply, it's just trading with borrowed money. Now, it's great when you're right, it magnifies your wins, but it's absolutely devastating when you're wrong because it magnifies your losses just as much. A tiny little price dip can totally wipe out your entire investment if you're using too much leverage.
And the second term you gotta know is liquidity. All this means is how easy it is to find a buyer when you want to sell something. But when everyone is trying to sell at the same time and nobody wants to buy, liquidity just vanishes. We call that thin liquidity. And let me tell you, it is incredibly dangerous in a panic. And this chart just illustrates the problem perfectly. Right before the crash, there was almost $17 billion betting that prices would go up. Compare that to only $2.5 billion betting they would go down. The market was just dangerously, overwhelmingly optimistic. It's like everyone was packed onto the same side of the boat, making it super easy to tip the whole thing over.
So here's exactly how all that optimism became a weapon. First, the tariff news hits the market. That causes prices to dip, just a little bit. But that tiny dip is enough to trigger automatic sell-offs, those liquidations we talked about, for the traders with the most leverage. That forced selling, in turn, pushes prices down even more, which then triggers a whole new wave of liquidations. It's a nasty, self-feeding domino effect.
But hang on, there is one more critical piece to this whole puzzle. A very specific vulnerability that turned what was a bad day into a truly historic catastrophe. This wasn't just market physics at play. This was a flaw just waiting for someone to exploit it.
So on one of the biggest exchanges in the world, there was a loophole. Certain assets you could use as collateral, the money you put up to back your trades, were being valued based on the exchange's own internal price, not a stable outside price feed, which is how it should be. The exchange knew this was a problem, and they had a fix scheduled, but on October 10th, that loophole was still wide open.
And here it is. This was the kill shot. Some attackers, seeing the market was in a total panic, exploited that exact flaw. They manipulated the internal price of a key collateral asset called USDE, and they crashed it down to 65 cents, but only on that one exchange. And in an instant, this vaporized the value of traders' collateral, triggering $1 billion in liquidations on that single platform alone.
So, the damage was done. Billions were gone. But when all the dust finally settled,
the story got a little more complicated. The verdict on what this crash really meant for the future of crypto was surprisingly nuanced.
Let's be very clear about this. For every loser, there was a winner. On one side, you had 1.6 million regular traders and a bunch of crypto hedge funds that got completely wiped out. But on the other side, coordinated short sellers, a mysterious Bitcoin whale that hadn't moved coins since 2011, and a group that got nicknamed the Hyperliquid Short Squad, they reportedly made hundreds of millions of dollars from all that chaos.
Okay, now this might be the most important takeaway of this entire explainer. Unlike the big collapses of 2022, like FTX, which were basically caused by fraud and companies going broke, this was totally different. The 2022 crash was a credit crisis, a failure of trust, a failure of institutions. The 2025 crash was a liquidity crisis. It was a brutal mechanical flush of too much risk. The system didn't actually break. It worked exactly as it was designed to, just with merciless efficiency.
And this slide right here is the proof. Even with all that carnage, the core financial plumbing of crypto held up. Major stablecoins, they stayed pegged to the dollar. DeFi protocols kept running without a hitch, and most importantly, no major exchanges went bankrupt or froze customer withdrawals. The blockchain itself never even blinked. In a weird way, this was a sign of a more mature, more resilient system.
So all of this leaves us with one final, fascinating question. Was this $20 billion meltdown proof that crypto is just fatally flawed and way too dangerous? Or was the fact that the system bent but didn't actually break, that it survived a shock that would have killed it just a few years earlier, was that actually a sign of its growing strength? And that, well, that's something the entire market is still trying to figure out. Thanks for joining us.